Okay, so did you know that the global forex market trades over $7 trillion every single day? It's literally a massive, non-stop machine. Today, we're going to unlock exactly how Islamic finance interacts with that giant market. We're diving deep into the AAOIFI Shariah Standard No. 1, which is the ultimate rulebook governing trading in currencies. Our goal here is to really demystify this standard and separate what's perfectly permissible from what is strictly prohibited in modern money trading. Let's get right into it.
Because, it all boils down to one incredibly common question we hear all the time. Is forex trading actually halal? Look, we live in a deeply connected global economy, right? We're buying things online from overseas, businesses are constantly importing goods, families are sending remittances back home, and all of that requires exchanging money. So, how does this very everyday reality actually fit into Islamic law? Well, let's find out.
Okay, let's dive into this. Here's our quick roadmap for today. First, we'll cover the basics of Islamic exchange. Second, the rule of immediate possession. Third, avoiding riba in currency. Fourth, modern tech and halal hedging. And finally, we'll wrap up with the problem with speculation.
Starting us off, Section 1, the basics of Islamic exchange, understanding the rules.
Before we jump into all the complex banking mechanics, we really have to lay down the groundwork. Currency exchange isn't just a Wall Street thing, it's a completely normal, daily necessity. And the foundational philosophy here is that Islam is inherently pro-trade. It absolutely does not prohibit exchanging money. However, it is strictly anti-exploitation. The standard prohibits unjust profit, massive uncertainty, and any speculative transactions that end up harming society. So the exchange itself, that's halal. But the method? Well, the method matters immensely.
Moving right along to Section 2, the rule of immediate possession, also known as the rule of qabd.
Now, this is exactly where the standard gets very specific. The absolute most critical Sharia requirement you need to know is qabd, which is the golden rule of immediate possession. Let's say you're trading US dollars for euros. Under this rule, both parties absolutely must exchange that money right then and there, before parting ways. You literally cannot hand over your dollars today and say, hey, just give me the euros tomorrow. Why? Because delaying the exchange of currencies basically opens the door wide open to riba, or unjust increase. It has to be immediate.
Now you might be sitting there wondering, immediate possession? Wait, do I have to hand over literal bags of gold coins like a pirate every time I do business? Not at all. The standard perfectly accommodates our modern world. On one side, yes, we have actual possession, which is your classic physical delivery by hand. But on the other side, we have what's called constructive possession, and this simply means gaining effective control over the money. So a successful wire transfer, a cleared check, or even just a confirmed credit card ping, all of those count. The standard actually enthusiastically embraces modern digital banking.
And just to add another fantastic layer of convenience, the standard explicitly allows for agency. You definitely don't have to execute every single trade yourself. You can appoint a bank, an agent, or a broker to exchange currencies on your behalf. That's totally fine. But remember, that golden rule still stands. That strict condition of qabd, or immediate possession, absolutely must occur before the transaction session ends.
Okay, moving to Section 3, avoiding riba in currency and looking at equal exchange rules.
So we've talked a bit about exchanging different currencies, but what happens when you're dealing with the exact same currency? Well, and this brilliantly illustrates the point. The standard draws incredibly strict mathematical boundaries here. Exchanging $100 for $100? Completely allowed, no problem. But exchanging $100 for $110? That is strictly prohibited. Any increase in the exchange of the exact same currency without any real underlying economic activity is the literal definition of riba. It's a massive red line.
Now, the standard also very practically addresses real-world debt scenarios. Say you owe a debt in US dollars, but for whatever reason, you want to repay it in euros. Is that allowed? Yes, actually, it is, but with one major caveat. The exchange must happen immediately, using the market rate on the actual day of payment. You absolutely cannot fix a future rate beforehand for some delayed transaction. The fairness of the deal has to reflect the actual reality of the market today.
Which brings us right into Section 4, modern tech and halal hedging, managing risk safely. So we've just established these very strict rules against future contracts. But if you think about it, that raises a pretty massive practical issue for large Islamic banks operating in this crazy volatile global market. I mean, how do they actually protect themselves?
If currencies are constantly wildly fluctuating, how do these institutions manage the very real risk of currency depreciation without accidentally violating Sharia law? Well, the standard actually provides some really clever Sharia compliance shields. Instead of using prohibited conventional futures or forward contracts, Islamic institutions use what we call halal hedging. For example, they can use interest-free back-to-back loans, or they might use maraba transactions, which are essentially these highly transparent cost-plus financing structures done in the same currency. These methods allow banks to effectively mitigate their risk while staying entirely 100% within Islamic bounds.
And this brings us to a powerfully ethical principle derived straight from the standard, which is, a good objective does not make a haram method permissible. Think about that for a second. Even if a bank's ultimate goal is incredibly noble, say they're just trying to protect everyday depositors' savings from a market crash, they still cannot use non-compliant tools to do it. In Islamic finance, the ends never, ever justify the means. The structural integrity of the transaction itself is literally everything.
And honestly, I want to note enthusiastically that Islam is definitely not against technology. Contracts made through mobile apps, online trading platforms, or digital systems, they are completely valid. As long as the platform ensures total transparency, clear mutual agreement, and importantly, fulfills that strict rule of immediate possession we talked about earlier, your digital transactions are perfectly compliant.
Finally, let's look at Section 5, the problem with speculation and why intent matters. Now, what's really interesting about this slide is the stark contrast it highlights. Having understood the rules of possession, we really have to look directly at the modern retail forex market. Islamic finance demands immediate exchange that's intimately tied to the real economy. The conventional forex market, on the flip side, often features delayed settlements, no actual physical or constructive possession of the currency, and is driven purely by speculation. On a lot of these platforms, currencies are just traded back and forth, without anyone ever intending to actually hold or use the money. And honestly, that kind of pure speculation goes against the very spirit of the standard. The core philosophy here is that money is just a medium of exchange. It's meant to support actual trade, real investment, and tangible economic growth in society. It is absolutely not meant to be a commodity that's just bought and sold for gambling-like profits. And this is exactly why highly speculative day trading on retail forex platforms is generally considered non-compliant with Sharia law.
Which leaves us with a final, very profound question. If the fundamental purpose of money is truly to build and support the real economy, we kind of have to look at our own lives. Are the everyday financial tools and platforms that you use acting as a bridge to real economic growth, or are they functioning more like a casino? It's a fascinating question that really challenges how we view all of our financial interactions.